You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Tesco's, ASOS, Sainsburys, Halfords, M&S, and our US company of the week is Match. Sam, shall I kick us off with Tesco's?
Absolutely. Favourite of the show.
Very much. And it's also the UK's largest retailer. They had a trading statement out for the 19 weeks to the 7th of January, with retail sales rising 6.4%, which included 7.9% growth over the Christmas period, and growth in all regions, with fresh food performing particularly strongly, up 8.1%, helped by promotions including the Aldi price match, low everyday prices, and the club card deals, in addition to market-leading availability for food itself. Finest festive range expanded 22%, and the Finest sales were up 8.2%. And on a 3-year like-for-like basis, sales are up 13.9%. The club card satisfaction rate increased and is the highest ranked supermarket loyalty scheme in the UK. In the UK, the group retained a 27.5% market share and net switching gains in December. Online orders came in at over 1.1 million weekly and are 52% above levels pre-pandemic. And the Tesco service is the leader in the online grocery industry. In the wholesale business, Booker performed strongly with sales up 10%, with double-digit growth in catering up 19.2%, which was partly driven by price freezes for customers. Meanwhile, the Tesco's Bank saw increased credit card spending, ATM and travel money activity returning to normal, which helped sales rise 14.6%. The cost-saving programme the group implemented now looks set to deliver $1 billion in savings over 2 years rather than the 3 originally expected. In terms of outlook, retail adjusted operating profit is expected to be between £2.4 and £2.5 billion. Retail free cash flow of at least £1.8 billion and bank adjusted operating profit of around £120 million to £160 million. In terms of valuation, Tesco's has a market cap of around £18 billion and trades at 11.5 times forward earnings, and it currently yields in the region of 4.5%. I am a Tesco shareholder, and I thought these numbers were decent, particularly in the economic climate, both growing the sales and maintaining the dominance, 27.5% market share. It's also in the strongest position financially to compete with the weakened opposition in the forms of Morrisons and Asda, which have been acquired by private equity in recent years and loaded with debt. And they're also, we're not seeing that repeat of the mistakes that they made after the last financial crisis, when they were trying to maintain the margins, but they were hiking the prices really aggressively and then losing market share to Aldi and Lidl. They're not doing that this time. So I think in the circumstances, these are really good results, and we'll discuss some of the other retailers later, but I'm still very happy being a Tesco shareholder. Sam, what are your thoughts on these figures?
I think they're really impressive. I think, all right, the rise is not as high as inflation, but I wouldn't have expected it to be. I think they've held their own. They've increased sales a decent amount, and they've obviously increased prices a decent amount in areas, but I think the main thing for them is just holding the market share. This is just not an economic environment that favours them. It does favour like Lidl and Aldi and B&M, for example, which we covered last week. I think if they can just hold their own, then once the economic climate starts to change, they'll be very, very well positioned. But I think it's a very, very good performance. I think the valuation is very reasonable, and I think the dividend's very good as well. I think it's just a really well-run business. I don't have much to say other than just agree with what you've said.
Do you think it would fit in your portfolio?
I don't think it would fit in my portfolio right now. I think if my portfolio was more geared towards income, I think that 4.5% dividend would look very, very tempting. And I do like the business a lot, but it's pretty saturated as well. I'm not sure where the growth would come from for Tesco, but as a business, I really like it.
Yeah. And I suppose it did try to have those growth plans in the past and break America, go into Thailand, and
Hyper stores as well.
It didn't. Yeah, it didn't work. So it's gone back to basics, and it's doing well with that.
Yeah, no, I like the business, but it's not for me.
No, fair enough. Okay, ASOS.
Yes, so ASOS, the online fashion retailer, have come out with a Q1 trading statement. So this statement covers the 4 months ended 31 December 2022. So revenue was down 3%, broadly in line with expectations, reflecting challenging trading conditions and prioritization of structural profitability improvements and cash generation through a more disciplined approach to capital deployment. Adjusted gross margin is broadly flat at 42.9%, with encouraging progress through the period relative to the prior year, with significant improvement expected in the second half of 2023. Significant progress was made against the driving change agenda, with profitability measures identified for the financial year 2023 in excess of 300 million. The majority are now in delivery phase, with benefits accelerating in the second half of the 2023 financial year to more than offset inflationary headwinds and normalization of return rates. Balance sheet flexibility has been retained, with cash and undrawn facilities of about 430 million, in line with the plan and reflecting typical seasonal working capital flows. They're on track to reduce 2022 financial year inventory levels by about 5% at the end of the first half. The full year guidance for cash outflow is between £100 million outflow and break even. ASOS continues to expect significantly improved profitability and cash generation in the second half and beyond, following the first half loss. So for the sales by region, UK sales were down 8% to 591.3 million. EU sales were up 7% to 417 million. US sales were up 15% to 198 million, and rest of the world was down 30% to 129 million. Active customers is flat at 25 million or 25.5 million, reflecting the annualization of benefits of COVID tailwinds to customer acquisition. In terms of the valuation, the business trades at a forward PE of 21, and that compares to a 10-year average of 39. It's not currently paying a dividend, and the shares rose 9% following this announcement. My view was, I thought the drop in revenues was a bit disappointing. I would have liked to have seen them holding their own in terms of revenue. However, the customer number is flat, which I suppose is slightly more important, in that at least they're retaining the customers, or at least they're getting enough to make up for the churn. And if those customers are ordering a little bit less, I suppose that's not that much of an issue. Whereas if customer numbers were dropping with revenue, I think it'd be a lot worse. One thing I thought that was particularly encouraging, I mean, firstly, it's worth noting, when you actually look through, it does look like there's actually the potential for quite a profitable business in there, even if it doesn't return to growth, which I think it will. But then when you look at those figures, I actually think it tucked away in those numbers, the US growth of 15%, I think, is pretty good. And we've discussed it before, but the US total sales are about a third of the UK. And if they can carry on growing that, I think it's very, very cheap. John, what are your thoughts?
Yeah, no, I would pick up on the US growth too. And also, if that's an early sign for things the way we might go, and if economically things pick up more in the UK, then delivering better numbers back at home. But then also, as you point out, the future for further growth in the US, and it is a decent figure. So I think you've got to look in terms of the much longer term with ASOS. And I appreciate if you've held the shares, it's been a very bumpy ride, but that was for a very highly priced stock. So I think it's a much more reasonable price, although it's clearly not without risk. I still prefer Boohoo of the two, but they are, in almost exactly the same industry.
Both trying to crack the US as well.
Yeah, that's right. Nothing to say that they both can't, but yeah, I think there's more to it than just on the surface seeing the 3% revenue drop. That's how I'd look at this.
I would agree. And I think the share price increase of 9% after the announcement suggests that quite a few people agree with you. And I do think this actually, as Boohoo shareholders, which we also have in our fantasy portfolio,
So
unfortunately.
a lot riding on it then.
I think it does bode quite well for Boohoo too, because like you say, we do expect the results to be pretty similar, although we do prefer Boohoo slightly as a business. So yes, with that, should we move on to your next retailer, John?
Yeah, it's a retailer special this week. So Sainsburys, the UK's second largest listed supermarket, had a trading statement out for the 16 weeks to the 7th of January, with total retail sales, excluding fuel, rising 5.2%. This included a 7.1% growth over the Christmas period, and grocery sales were 5.6% up in the quarter and 12.5% ahead of 2019 levels. This was largely as a result of higher prices, but also perceived value, with similar price matching strategy as Tesco had with Aldi. However, Sainsbury's is still behind the supermarkets in relation to price rises, which is contributing to the performance. General merchandise sales grew 4.5%, with a strong performance from Argos over Christmas as people moved in-store for gifts, particularly electronics, as the Royal Mail were on strike. And those electronic sales, or tech sales, were up by nearly a quarter. Clothing sales were up a more modest 1.3% on last year. This recent performance has led the group to upgrade their expectations for full-year underlying profits before tax to be towards the higher end of £630 to £690 million, with cash flow of around £600 million, compared with previous guidance of at least £500 million. And although the guidance had been upgraded, it was on the back of recent downgrades. Otherwise, interestingly, the underlying retail operating profit margin dipped below the 3% mark in the first half. In terms of valuation, Sainsbury's has a market cap of £5.7 billion and trades at around 11.5 times forward earnings, yields 5% at the moment. So it's actually, in terms of valuation, it's more or less identical to Tesco's. I think when you look at the numbers, they're not that different. I think the Tesco's ones are slightly better. And what you would say about Tesco's, or what I think we both say, is it looks like a healthier, better run business than Sainsbury's. So given that they're operating in exactly the same sector, I would be choosing Tesco's every time. But given that Sainsbury's had a rougher couple of years, I mean, it has been helped by the pandemic, but relatively speaking, they're very encouraging signs, whilst not quite up there with Tesco's. Sam, what are your thoughts on these numbers from Sainsbury's?
I think they're pretty impressive results in that. I think this might be the first time we've covered it on a show where the figures have actually been in line with Tesco. Normally, it's a couple of percentage points behind Tesco. So I think that's very impressive. I think my main issue with it is, besides that, I think it's a worse business than Tesco. It's also got more debt. So they have hit their 4-year target of £950 million of net debt reduction a year ahead of schedule. However, you look at it and there's still... I'll just get it up. I mean, this is very, very back of a fag packet. But just looking at it, there's borrowings of about 7.3 billion, cash of 800 million. So you're at like 6.5 billion of debt, of net debt anyway. And that's an operating profit of 1.1 billion last year. So when the debt's 5 to 6 times the operating profit, that is at the level where I'd be uncomfortable with it, especially with interest rates going up. So although they've done well chipping away at that debt, I think they need to chip away at it a lot more. And I don't know why they've got a better dividend yield than Tesco do, because I think maybe that dividend would be, well, the reason is because most of the investors are buying it for the income. But I think if they were doing if management was to do what was in the best interest of the business, I think they should seriously consider cutting the dividend and paying that debt down a bit more, because although they've done quite well, they still have a long way to go. So yeah, Tesco's results slightly better, but not much. But I just think it's a much better business in much healthier shape.
Yeah, and it does have a lot more pricing power to weather that storm too.
Yeah. And also, I just don't like the Argos acquisition. I don't really see how it benefits Sainsbury's at all, to be honest.
I think you've seen it with that slight anomaly in the case of the Royal Mail strikes, people buying more consumer electronics this Christmas, but I can't imagine that being repeated.
No. And I think a lot of the time as well, like say you walk into Sainsburys and you have to get something through, or Argos. Is that really something that, like, a lot of the time, it's probably something you could have got anyway. I can't imagine it's added that much more. I just don't think the Argos like brand and stuff is worth that much anymore now that, like, with the internet and stuff. So yeah, I just prefer Tesco.
Whereas
Anyway,
when you look at the Booker acquisition that Tesco's made a few years ago, that made complete sense and has worked really well for the company.
yeah, I like vertical integration. I don't like just buying another business that doesn't really seem to add anything. The Tesco Booker acquisition was just a lot more strategic, I thought.
Yeah.
So
surprising it was allowed to go through, but it's worked really well.
Should we move on to another business with a questionable acquisition strategy?
Yes. Yeah. So yeah, it's in the sin bin on the show, really, isn't it? Halfords.
Yeah, we've covered it a few times. They've come out with a Q3 trading statement. Q3 trading update for the 13 weeks to 31 December. Oh, for God's sake. I actually downloaded the statement. And I've downloaded the last year's statement.
Is it the same? That's the question.
Well, we'll find out, but I didn't. I've just realised now because it's the 31 December 21. So they've come out with a trading statement, and their third quarter revenue rose 38.3% compared to pre-pandemic levels. The majority of this was
how much was that?
38.3%.
Oh, bloody okay, right. So I'll be quiet.
They do everything over 2 or 3 years though, so they don't really. They've stopped giving you comparisons to last year now because it's all up since the pandemic. Interestingly, they had it in last year's statement. They were giving the figures over 2 years, so maybe it was worth going through. Yeah, so they're doing it over 3 years, up 38.3%. Majority of this was driven by acquisitions, so not as impressive as it looks on the surface. Growth was driven by motoring and essential products, but overall revenues were weaker than expected because of weak cycling and tyre markets. Services now represent just over 50% of total revenue. Auto Centre's profit is being impacted by a shift to lower margin categories driven by a nationwide shortage of skilled labour. There are now 1.2 million Motoring Loyalty Club members, which is better than expected. The tough market conditions, especially an inability to hire enough skilled staff to service demand, means full-year pre-tax profit expectations have been lowered, with the group now expecting a pre-tax profit of 50 to 60 million compared with prior guidance that this would be at the lower end of the 65 to 75 million range. Halfords also said, we anticipate year-on-year cost inflation in wages, energy and currency. However, we will partially offset these pressures through realising reductions in freight and product costs while simultaneously continuing to reduce our cost base. The shares fell 12.8% following the announcement, and in terms of valuation, the business now trades at a forward PE of 8.9, and that compares to a 10-year average of 11.6, and the prospective yield is 4%. I don't like this business. I don't agree the tyre market is weak. I think Halfords are just doing a poor job, and I think when you look at what's going on with the car market at the minute, I think because less people are buying newer cars because they're hard, people are just wearing out the older cars more, and that includes tyres. I think when you look at what's happening with the second-hand market, that should be flowing through into tyres, and I suspect for other businesses it is. I just think Halfords aren't doing a very good job with this. I don't particularly like the acquisition strategy. I know they did an equity raise to finance some of it, but I don't like the fact that they're going on this acquisition spree. And they've still got a 4% dividend. I just think, if that is the strategy to grow the business, cut the dividend to zero, because the shareholders should be with you along for the ride if that's what you're doing. There's a lot of things I don't like. Some of them are the same as last time, some are slightly different, but I don't like the business. I don't even think it's particularly cheap, really, for such a poor business. I think 8.9 times earnings for a business that's just going out and buying things that don't seem to make much sense. And I don't think the management seems to be covering themselves in glory. I just do not like this at all. John, what are your thoughts?
Yeah, pretty much the same. We've said it before, but I mean, there's the acquisition strategy of, I suppose it's local or garages with sort of small chains, but that's an industry that is in structural decline with the move to electric cars and having fewer serviceable parts. Also, that around 90% of Britons buy their cars on credit, and they often have servicing included in that. And also people cutting back on servicing in a cost of living crisis. And then on top of that, you've got the cost inflation from all of your, I suppose, skilled workers, all of your mechanics. And yeah, you made a few points on the tyre market too. So I think it's a flawed strategy, and I just don't see it ending well. So I wouldn't touch the Halfords shares with a barge pole.
I think even if we like the strategy, it's in such a tough industry anyway. I don't think I'd still want it. But yeah, when it's what I consider to be a poor business in a very tough industry too, I just don't like it. Should we move on to what used to be a poor business, but seems to be improving in recent years?
Yeah, so I suppose you could say it's on the most upmarket of the grocers this week. It also sells clothes. Marks and Spencer's, they had a trading statement out for the 13 weeks to the 31st of December, with group sales up 9.9% to £3.6 billion and growth across all of the business. M&S Food, the largest division, grew sales by 10.2% to £2.1 billion over the Christmas period. Clothing and Home saw sales rise 8.8% to £1.2 billion. The group credited their omnichannel platform with Click and Collect growing by 20% and third-party brand sales up 50%. Formal wear increased by over 40%. Online sales increased by 0.7%, driven by growth of 33% through the M&S app. The group also acquired Gist, the logistics provider, and this is expecting to have a positive effect going forward on total food sales, with the grocer controlling more of the supply chain and more able to improve the margins. M&S also managed to strengthen the balance sheet and liquidity position by extending their £850 million revolving credit facility by 1 year to June 2026. In the face of ongoing cost and inflationary pressures, M&S is still expecting the outcome for the full year to be in line with previous guidance from November. Ocado Retail was not reported in the numbers, but M&S volumes through Ocado Retail represented around 30% of average basket size on ocado.com over the Christmas period. In terms of valuation, M&S has a market cap of just under 3 billion and trades at 10 times forward earnings with a yield of 3.5%. On the service, I thought these numbers were really good. I mean, when you're comparing them with the first two retailers we had, they are better. I suppose it really depends on how you see the longer term future of M&S. I don't know. I think the food business is the really attractive bit. I'm not convinced by the clothes. I know they're turning it around now, but in the long term, and there's a highly, highly competitive market, I don't think they still have a niche there. And also the Ocado, which they didn't mention, I think that's a bit of it is a drag on the business. And the balance sheet it's not as good as Tesco's. So I wouldn't be buying M&S at 10 times earnings. I appreciate it. On the surface, it's cheaper, but I think that's for a good reason. Sam, have you come round to buying shares in M&S yet?
Absolutely not. Although I just think the turnaround in the performance of the business over the last two or 3 years has been very impressive. So I think management do deserve credit for that. I think they're doing very well with what they've got. I wouldn't have predicted Marks and Spencer's to have the best Christmas performance out of the three we've looked at. I would have bet on Tesco, so that was surprising, and it didn't just beat Tesco; it absolutely beat it very comfortably. I think the Click and Collect order is growing by 20%. I think that's quite interesting. If they can leverage their existing sort of store base, I don't think they could do it anywhere near as well. But for example, like Next have been able to. Who knows? It could certainly be interesting anyway, and it is a lot of encouraging signs. I don't think the valuation is outrageous, but it does have a lot of debt, similar levels to Sainsburys, actually. If anything, the debt's worse because at least Sainsburys use a lot of their debt to finance Argos, which, although we don't like it, it's a half decent business. Whereas a lot of the M&S debt came from the financing of Ocado, which I think has just proven to be a terrible investment. The fact they're not even mentioning it, given the amount they paid, is just ridiculous. Ocado, I haven't looked at it properly, but they had a statement out the other day. That wasn't particularly good. I think they had a revenue drop. That was a very, very poor acquisition. And I don't think you needed to be a genius to work it out. I think M&S were just in quite a poor place at the time, and they felt like they needed to do something. And I think because they had this image as well of being sort of quite old-fashioned and stuff, I think that's partly why they were attracted to the glamour of Ocado. But last couple of years, the business performance has been very, very good. But as an investment, I still wouldn't want to go anywhere near it.
Fine. Well, in a nutshell, what about our US company of the week?
Yes, so our US company of the week is Match. So I just wanted to cover this. So I've just gone through the last set of results, and these results are from back in November. But I think we may have done it once before, and the valuation was too expensive. I know we've definitely done Bumble recently, but I just wanted to revisit it because it is it's a business I really like. I do like monopolies. Some of the best brands they've got, Match.com. It's a dating website, obviously. OkCupid, Hinge, Plenty of Fish, and their biggest one is Tinder. They've also got lots of other small and fairly niche ones. So they came out with their Q3 results in November. I mean, you have to take these with a pinch of salt because they're now 2 months old. So the next set of results will be here in a month in any case. But total revenue was up 1% over the prior year to 810 million, and that was 10% growth on a foreign exchange neutral basis. Operating income was 211 million, that's in dollars, as are all the other figures, a decrease of 5% over the prior quarter, representing an operating margin of 26%. I think that operating margin could be quite a bit higher given the strength of the business. And so do they, because they've adjusted it to 35% payers, which is the paying users, increased 2% to 16.5 million, up from 16.3 million in the prior year quarter. Revenue per payer, I think that was flat over the prior year quarter at $16.02, but up 9% on an FX neutral basis. Tinder Direct revenue grew 6%, and that was up 16% on FX neutral over the prior year quarter, driven by 7% payers growth. All other brands collectively had a direct revenue decline of 5% year over year, driven by an 8% payers decline. Within all other brands, Hinge Direct revenue grew nearly 40% year over year. Year to date, operating cash flow and free cash flow were 300 million and 262 million, respectively, impacted by the $441 million payment related to the previously disclosed Tinder litigation settlement in the second quarter of 2022. So I think that was something to do with sexism or sexual harassment or something like that. They've also, so from the letter to shareholders, they've said, I've just taken a couple of bits out, but Hinge continues to achieve all-time highs in users and grow its market share globally. The Azar app at Hyperconnect has returned solid growth, and we are continuing to supplement our management teams to better position us for the long term. In addition to reigniting Tinder growth, in 2023, we plan to focus on targeted, high-returning investments, especially in Hinge and The League, as well as some newly incubated apps where we see further opportunity to better serve select demographics and markets. Because we expect a challenging operating environment for the foreseeable future, we plan to accelerate our efforts to control costs, especially in headcount-related expenses and marketing spend in other areas of the business. And they've talked about the market opportunity a bit more, and they've said, and this is for Tinder, but they've said even as Tinder's user base continues to grow every quarter, it still has ample opportunity for growth ahead, especially in the less penetrated countries outside of the Americas and Europe. Asia Pacific and China and other represents 18% of Tinder Direct revenues in Q3 and grew 8% year over year, and that's 27% on an FX neutral. Despite the continued challenges in Japan, we expect this strong growth to continue. Although the growth has slowed in some of Tinder's more developed markets in Americas and Europe, our objective is to create innovative features and compelling marketing campaigns that give daters more reason to use Tinder. In the 10 largest markets in the US, on average, about 15% of eligible singles between 18 and 24 use Tinder on a monthly basis. I'm surprised how low that is, to the point where I almost don't believe it. Because I just think of like unmarried population that are eligible, that could be a lot higher.
Mm-hmm.
I'd have thought it'd be more like 50%, just based on like what it's like with people I know that are single. And then they've talked specifically about Hinge as well and their international expansion. So the same, we're seeing continued success with Hinge, especially as we expand the product into new markets throughout Europe. Germany is off to a strong start, with the app rising from the 20th to the 4th most downloaded dating app in September. Following the success in Germany, the surrounding region, Hinge has rolled out and translated localized products and began marketing campaigns in Sweden. Hinge plans to roll out localized products in France, Italy, and Spain in Q4, with marketing campaigns to follow in early 2023. With a strong initial traction seen in newly activated markets and the halo effects we've seen across other European countries, we're as confident as ever in Hinge's long-term international growth potential and are continuing with our accelerated expansion efforts. So I think those are the main points I wanted to talk about. In terms of the valuation, the business has a market cap of $13 billion, which I think is significantly lower than when we last looked. It trades at a PE of 135, but the price to sales is only 4.13, and it trades at 28 times free cash flow for the previous 12 months. One thing I also thought, I think this business's biggest expense is probably the App Store fees, because it's losing about 30% to Apple and Google of any transaction within or any subscription that's done on the mobile. I think over time that will come down. I think the Apple and Google walled gardens on app stores, I think they will come under more and more pressure over time. I think where it's currently 30% in 10 years' time, I don't think it will be anywhere near that. And that would significantly increase the operating margins. In terms of the share price, so I don't know when we last covered it, but this reached a peak of about $160 a share in June 21. And it's now trading at $47 a share. It looks like the low was, or the 12-month low was 38. So it's pretty close to that, actually. So yeah, my conclusion, I thought these results were pretty good given the economic environment. I think it is basically a monopoly. I think they've still got a lot of potential for international expansion. I think at 28 times free cash flow, I don't think it's that expensive for the quality of the business you're getting. I really do think this, I mean, some of the brands it's got, I think if they can retain those from generation to generation, because I know with the millennials and the, or whatever you want to call them, the Zoomers, I think they do have very, very strong traction. Whether or not that carries on, or you get to a point where almost people don't want to be on the same apps that their parents met on in 20 years' time, and they need to come out with that. But you know what I mean, though? And they need to come out with that next thing. I don't know how that affects it, but certainly for a generation, I think it's going to be a fantastic business, and I think it's got a lot of growth ahead of it. John, what are your thoughts on the results in the business, especially compared to last time?
Yeah, I would tend to agree with you. I think it's got the best brands, and it's a growth industry. The share price has pulled back a lot, and I suppose this is the big question about the valuation. On conventional metrics, it's very expensive. So that would probably put me off, but I certainly wouldn't bet against it. And I think there is huge growth ahead. But yeah, it's just paying up for it, I think.
What do you think of the market cap, though? Because $13 billion doesn't seem that expensive for the dominant dating app.
No, it doesn't. And I think these are the sorts of, I suppose this is the case with a lot of the growth stocks that you could make that it's, well, the size of this market is much, much, much bigger than that. Yeah, tricky. Would you pay up for shares then?
I don't know. I think I'd be much more likely than last time. It's definitely going on the watch list. I think it's good enough. But there's a lot of options at the minute. And obviously, although the share price has done poorly, there is the exchange rate to consider as well. I know you shouldn't, because we don't really know anything about where the exchange rate is going to go. And we might look back in 10 years and think, oh, I wish I'd bought more dollar stocks. Yeah. Because look how high the exchange rate was. But I just think certainly for the next couple of months, I think there's quite a few businesses I own that I'd like to add to before I started a position in Match. Like for example, I would, in my own portfolio personally, I'd probably, I'd rather top up Disney in the near future than start a new position on Match. So it's more the opportunity cost, but I really like the business.
And it's got several strong brands in it. It's not just one, which I think is, really.
And then you look at the results for Hinge, which is quite small, and then that's growing 40% a year. And they seem to be backing Hinge quite a lot. And it is quite encouraging, because they've obviously got Tinder that's just so dominant. And then they've got like Match.com, which, pre the apps was probably the dominant, well, it was the dominant dating website. So they do seem to have a bit of a knack for it. Whereas like you look at Bumble, and apart from Bumble, I know they do have one or two other ones, but like apart from Bumble, I can't think of any of their others that I recognise. Whereas Match, they've got quite a few where it's like, oh yeah, I know that one, I know that one. So yeah, I do like the business a lot. It's a business I would like to own at some point, I think.
Yeah. It's just, I suppose, paying up for it, isn't it?
It is, yeah. Although it's, you're paying less than you were a year ago.
Which was a lot.
It was a lot, yeah. But it's now trading. So 5 years ago, it was at $44 a share or $40 a share in February 1st, 2018. Yeah. So it's not moved in 5 years.
Yeah.
I bet the business is a lot better.
Yeah.
So
yeah, no, absolutely. But then it was just in 2018, was it just an outrageous valuation?
Yeah, I think there's some of that. I mean, if you look at the graph, it's like one of those exponential ones, but then it's dropped back down after. But yeah, I like it a lot. So of the 6 businesses we've covered this week, Tesco, ASOS, Sainsburys, Halfords, M&S and Match, if you had to buy one, which one would it be?
Good question. I do own Tesco's. But if I were buying one today, thinking about the long term, I'd probably go for ASOS,
What if you didn't own Tesco?
Might still go for ASOS.
Oh, really?
I think it's that future growth ahead of it and not being an outrageous valuation. Well, certainly not an outrageous valuation at the moment. Oh. I do like Tesco's, and I think the quality is there. But for that growth, I think I probably would go for ASOS now.
I'm surprised with that. I think at 28 times free. Oh, to see that still when I say it actually out loud, it doesn't sound as cheap, does it? I think if we're talking sort of 5-10 years, I'd probably go in Match because I think there's still a lot of growth left in this. I really do.
Yeah.
But yeah, I'm going to go with Match. But yeah, you did make me think there. So before we finish, we should mention as well that for anyone who is interested, we're going to the Fundsmith AGM on the 28th of February to listen to Terry Smith speak and go through the Fundsmith result. If anyone does want to go, there's a link on the Fundsmith website, and if you can't find it, if you just send us a tweet at TIW Tweets, we'll send it to you. So if anyone does want to go and grab a drink before or after, please do let us know.
Very much looking forward to it and looking forward to seeing everyone there. See you soon.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.